You're taking bad trades, not because you don't know better, because you're not asking the right questions before you enter. Most traders have a system, they know what to look for, but they skip the filter. They see something that looks close enough, and they go. And that's why they lose. The difference between profitable traders and everyone else isn't strategy. It's the questions they ask before pressing the button. 5 questions. Every single trade, no exceptions. If any answer is no, you don't trade. Not maybe. Not this time, it's different. No means wait. Let me show you the exact 5-step test that separates random entries from perfect entries. Let's begin. Step 1. Does the higher time frame support this trade? This might be the most effective filter. This is the first question because it's the most important. If the answer is no, nothing else matters. You can have the perfect setup on the 1 hour, clean structure, strong momentum, every indicator aligned. But if the 4-hour chart is trending the opposite direction, you're fighting the current, and the current always wins. Check the 4-hour. Check the daily. Are they trending the same direction as your trade? Not ranging, not choppy. Clearly trending in your direction. If yes, continue to step 2. If no, stop. Close the chart. Wait for the next setup. There is no exception to this rule. I don't care how good the lower time frame looks. If higher time frame doesn't agree, you don't trade. This one filter will eliminate 50% of your losing trades. Because most losses come from trading against the bigger picture. You're trying to catch a reversal that isn't ready. You're buying a pullback in a downtrend. You're selling strength in an uptrend. All because you didn't check higher time frame first, so check it. 4-hour minimum, daily preferred. Is the trend clear? Is it in your direction? Yes or no? No means wait. It's that simple. Set your own criteria for interpreting the higher time frame according to your system. Determine a trend accordingly and don't trade against it. This is non-negotiable. Step 2. Can I say yes to this setup in 3 seconds or less? Look at your chart. Is this your setup? You should know instantly. Not maybe. Not I think so. Not it looks similar. Instant yes or no. If you have to think about it, the answer is no. This is the clarity test, and it kills the biggest trap traders fall into. Taking setups that are close enough. You have a pullback setup, you're looking for price to pull back to support and reject. Then you see price pull back halfway to support and bounce, and you think close enough. It's not. That's a different setup. Or you're waiting for a breakout with volume. Then you see a breakout with weak volume, and you think maybe it'll pick up. It won't. That's not your setup. Close enough is not your setup. Similar is not your setup. Kinda looks like it is not your setup. Your setup is your setup. And you know it when you see it in 3 seconds. Apply this filter. If it takes longer than 3 seconds to decide, you're convincing yourself. And convincing yourself means you're forcing a trade that isn't there. 3-second test. Look at the chart. Is this exactly my setup? Yes or no? No thinking. No rationalizing. Instant answer. If it's not instant yes, it's no. Of course, your setup should be quite mechanical. If you have a discretionary setup, falling into your own trap becomes inevitable. So build your trading strategy based on mechanical and objective questions, not interpretation. This is very important. Here's why this matters. Hesitation means uncertainty, and uncertainty means you don't have an edge. When you see your actual setup, there's no question. You've seen it 100 times. You know what happens next. You know the variations. You know when it works. That knowledge creates instant recognition. No delay. But when you're looking at something that's 70% your setup, you hesitate. Because it's not quite right. And that hesitation is your brain telling you this isn't it. Listen to that. Most traders ignore the hesitation. They talk themselves into the trade. They find reasons why this one is still good. And they lose. Because close enough setups don't have the same edge as perfect setups. The edge exists in the specifics. Change the specifics and the edge disappears. So don't take trades you have to convince yourself to take. 3-second test. Yes or no? Anything other than instant yes is no. Step 3. Am I taking this trade to make money or to be right? What emotion is driving me to take this trade? What am I feeling right now? This is the ego check. And it's the question most traders never ask, because the answer is uncomfortable. You're watching a stock, you called it, you told someone it's going up, or you posted about it, or you just thought it in your head, now it's moving. But your setup isn't there yet. The entry you planned isn't ready, but you feel pressure to get in, because you called it, and if you don't take it and it runs, you'll feel stupid. So you take a bad entry, not because it's a good trade, Because you want to be right about your call. To prove it, that's an ego trade. Or you took a loss yesterday. You said the market was going down, it went up. Now today you see another short setup, but it's not quite there. You take it anyway, because you need to prove you were right about direction, even though timing was wrong. That's an ego trade. These trades are not about profit. They're about validation, about proving something, about not looking stupid. And they lose, because the market doesn't care about your ego. It only cares about structure. So before every trade, ask this: am I taking this to make money? Or am I taking this to be right about something I said or thought? If the answer is to be right, don't take it. Close the chart. Let it go. Your ego is not part of your edge. Never allow it to be. Emotions can manipulate you. They can make you see your setup where it doesn't exist. So ask yourself before trading every setup: what's driving me? Is it my setup actually appearing? My need to prove myself? My addiction to pressing buttons? Or just boredom? Which one is moving you? The only thing that should move you is your setup. And your setup must be confirmed by the higher time frame. Let's remember that again. Here's the pattern. You'll see it once you start asking this question. Most of your worst trades are ego trades. The ones where you knew better but took it anyway. The ones where you broke your rules. The ones where you chased. Almost always ego. Wanting to be right, wanting to prove something, wanting to not miss out. None of those are trading reasons. They're emotional reasons disguised as trading reasons. And they destroy accounts. So ask the question: make money or be right? If it's not purely about profit, it's not a trade, it's an ego protection mechanism. And those always lose. You're usually not eager to take good trades. You don't rush. On the contrary, when you feel like I could skip this one too, that's often when good trades appear, when you're not desperate for them. And it's so clear and textbook that you think to yourself, if I'm not going to take this trade, which trade will I take? This is a very familiar situation. If you're thinking this way, you're probably acting correctly. Use this filter. Are you eager to take the trade? Are you saying, let all my confirmations come so I can take it as soon as possible? Or are you sitting at the screen thinking I could skip it, but maybe a trade could appear? Are you rushing? All these questions show what state of mind you're in. And if you're in the right state of mind, you'll probably take the right setup. If your emotional state is guiding you and you're in a hurry, you'll probably take a trade you shouldn't. So review your emotions. Notice which one you're more inclined to do. This awareness can protect you from unwanted losses. I'm talking about losses outside your setup. Let's continue with step 4. Step 4. How did my last 3 trades go and how do I feel right now? This is the state check. And it's critical because your emotional state determines your decision quality. You can have the same setup show up twice. Once when you're calm. Once when you're tilted. You'll see it differently. You'll execute it differently. And you'll get different results. Not because the setup changed, because you changed. So check yourself before you trade. How did the last 3 trades go? 3 wins in a row. You're probably overconfident. Feeling invincible. Thinking you can't lose. This is dangerous. And you know this, because overconfidence makes you sloppy. You'll take marginal setups. You'll increase size. You'll skip steps. All because you're riding high. If you just won 3 in a row, be extra careful on the next trade. Your mistake potential has increased, and you can take precautions to prevent this. Make sure it's perfect. Don't let confidence turn into carelessness. 3 losses in a row? You're probably desperate, feeling like you need to make it back, thinking the next one has to work. This is even more dangerous, because desperation makes you force trades. You'll take anything that moves. You'll chase. You'll ignore your rules. All because you're in pain and you want it to stop. If you just lost 3 in a row, don't take the next trade unless it's absolutely perfect. And even then, consider taking a break. Let the emotion settle. Come back tomorrow. After the emotion fades, your likelihood of making mistakes will decrease. Winning or losing consecutively definitely affects us, and their effects can push us to make mistakes. But if we're aware, we can act accordingly. Never give yourself the message that I won the last 3 trades, so I've earned the right to be more careless on the 4th. We want to treat all trades equally no matter what state we're in. This is the only way we can capture consistency and discipline. So whether we're overconfident or fearful, in any case, we must do what we need to do. Or don't do anything at all and wait for these feelings to subside. That's also a good solution. If you've won 5 times in a row, your likelihood of making mistakes has increased. Because you've become overconfident, You might even think you've figured out the market. Notice this and stay away until you return to a stable state of mind. This way, you'll avoid giving back the profits you've earned to the market for nothing. It's that simple. Mixed results: 2 wins, 1 loss, 1 win, 2 losses. That's neutral. That's the best state to trade from. No emotional bias, no overconfidence, no desperation, just execution. More realistic results make you more realistic too. So check your last 3. If they're all one direction, you're in a biased state. Be extra cautious. Now check how you feel. Are you stressed, angry, tired, hungry? Any of these states corrupt your decision-making. You think you can overcome it with discipline. You can't. Stress makes you impatient. Anger makes you aggressive. Tired makes you sloppy. Hungry makes you irritable. All of these lead to bad trades. We'll have videos addressing each of these individually. If you're not in a calm, neutral, rested state, don't trade. I know that sounds soft. It's not. It's the difference between profitable traders and broke traders. Profitable traders know when not to trade. Broke traders think they can trade through anything. They can't. Neither can you. So ask the question: last 3 trades? Current emotional state? If either is off, wait. The market will be there tomorrow. Your account might not be if you trade tilted. What's your life situation? Did you just go through a breakup? Then definitely take a break, because being disciplined in such situations may not be very easy. If you didn't get enough sleep, be extra careful that day. Watch charts less than normal, for example. Have your own filters according to your own situations, because your life is unique to you. Notice what increases your mistake potential and create solutions to not create an environment for them. For example, today I've been writing text since morning and I'm really starting to feel mentally exhausted. The New York session is coming soon and potential trade opportunities might appear. Because I didn't sleep enough last night and I noticed that I'm approaching mental exhaustion, I'm going to trade only 1 hour of the New York session that I've observed to be most productive. I'll look at screens less than normal, because my likelihood of making mistakes is a bit higher today. I'm aware. Even though I haven't broken my discipline for a long time, that doesn't mean I'll never break it again. I must take precautions. In fact, I might not look at charts at all today, and I must be completely at peace with that. Because markets are always here for us to trade, and opportunities will always exist. Why would I increase my mistake probability by chasing trades when my mental energy is depleted and I'm tired? I can wait for tomorrow. It's that simple. Step 5. Is my stop based on structure or based on fear? This is the risk management check, and it's where most traders fail without realizing it. You find your setup, higher time frame agrees. 3-second test passed. No ego. Good emotional state. You're ready to enter. But where's your stop? Most traders put their stop where they're comfortable losing. 20 pips, $50, 1% of account. These numbers are arbitrary, based on how much pain they can handle, not on where the trade is actually invalid. That's a fear-based stop. And fear-based stops get hit by noise. Then the trade goes to target without you, and it drives you crazy. But you deserved it, because you're acting out of fear, because you didn't give it room to work. Your stop should be based on structure. It should be in a logical place. Saying I'm putting this many pips stop and I always put that much doesn't make sense. Determine a logical stop point for each trade, and make that mechanical too. I personally always put my stop where the market structure I've identified would break. How far or close it is doesn't matter. I adjust position size accordingly. I'm sure you act the same way, but if there's anyone who still doesn't act this way, please put an end to it. Don't determine stop points arbitrarily. Let there be logic to it. Let it be appropriate for the time frame you're trading. If you're taking a 1-hour pullback to support, your stop goes below that support with room for one full 1-hour candle to move. That might be 60 pips. That might be 100 pips. Doesn't matter. That's what the structure requires. If that's too much risk for your account, you don't make the stop smaller. You make your position size smaller. It's that simple. Trade fewer shares, trade fewer contracts. But don't shrink the stop to fit your comfort. Because shrinking the stop doesn't reduce your risk. It guarantees your loss. You'll get stopped out on normal volatility. Then watch the trade work. Every single time you put a 20 pip stop on a 1-hour trade, this happens. Every single time. So check your stop. Is it below structure with room for the time frame's normal movement? Or is it at the edge of your comfort zone? If it's comfort-based, recalculate. Find the structural level. Measure the distance, that's your risk. If it's too much, trade smaller size. But never trade the wrong stop. Wrong stop equals wrong trade. Doesn't matter how good everything else is. If you insist on not placing your stop based on structure, then make your stop even wider. Not narrower. Wider. I'm completely okay with the idea of widening stops. This might make you earn less, true. But at least you're not unnecessarily tightening your stop. That's also a positive thing. 5 steps. Does higher time frame support this trade? Can I say yes in 3 seconds? Am I trading for money or ego? How are my last 3 trades and how do I feel now? Is my stop based on structure or fear? 5 questions before every single trade. All 5 answers must be yes. If even one is no, you wait. No exceptions. No, this time is different. No, but this looks really good. One no means wait for the next setup. This is the filter that separates consistent traders from gamblers. Gamblers see a setup and go. Traders see a setup and test it. The test takes 30 seconds, but those 30 seconds are the difference between 50% win rate and 65% win rate, between break-even and profitable, between hoping and knowing. Apply these filters. You'll see the difference. You might find some of these filters illogical. Let's discuss that in the comments. Then find your own filters and adapt them to your system. After all, you know yourself best. What matters is making trading easier and more sustainable for ourselves. That's the whole point. All these filters, solutions, videos exist for this reason. They all serve the same purpose. Here's what happened when I started using this 5-step test. My trade frequency dropped by 60%. I went from 10 trades a week to 4, and my win rate went from 53% to 67%. Not because I found better setups, because I stopped taking the marginal ones, the setups that looked close enough, the ones where I wanted to be right, the ones where I was tilted. All of those disappeared. Only perfect setups remained, and perfect setups have edge. I wasn't smarter, I wasn't luckier. I just asked 5 questions before every trade, and I only traded when all 5 answers were yes. That's it. That's the entire system. 5 questions, 30 seconds. Every trade. No exceptions. My likelihood of making mistakes decreased noticeably. When I was incredibly overconfident, instead of continuing to look for trades, I stayed away from the screen, because I was aware. This way, I protected the profits I made. I reduced my mistake probability. Naturally, my win rate increased. I had a more sustainable trading career. You can too. Don't be a degenerate. Avoid behaviors that feed those aspects of yourself, and repeat behaviors that make you more disciplined and more reasonable. That's all. Whatever you feed, you grow. Make sure you're feeding the right behavior patterns, the right thought patterns. Trading needs you, not the other way around. Markets wouldn't exist if people didn't exist. Don't act like you're desperate for markets. Wait until the markets are ready to deliver your setup and your profit to you, and don't do anything. That's the whole point. The whole point is making fewer mistakes. The whole point is managing not to take bad trades. Trades, you shouldn't take. If you're not yet a profitable trader, please don't be upset. This path isn't an easy path and won't be. But we can make it easier together. I'll try to support you with my team members to do this as much as I can. And together we'll make you a profitable trader. But you also need to do your part. Find your filters. Question your emotions. Know yourself. And develop. And stop being a degen. These are essential. If you found the video useful, liking it now will be motivation for us too. Most traders will read this and think it's too simple. 5 questions can't make that much difference. They're wrong. These 5 questions force you to do what profitable traders do naturally. Check context, confirm setup, examine motivation, assess state, verify risk. Every profitable trader does this. They just don't think about it consciously anymore. It's automatic. But when you're building consistency, you need it conscious. You need the checklist. You need the structure. Because without structure, you'll convince yourself that marginal trades are good enough. You'll skip steps. You'll rationalize. And you'll lose. The 5-step test removes rationalization. It's binary, yes or no. All 5 yes or you don't trade. No gray area, no maybe. No this time, it's okay. Clear rules, clear execution, clear results. So here's what you do. Write these 5 questions down, tape them to your monitor. Before you click buy or sell, read all 5. Answer all 5, honestly. If all 5 are yes, take the trade. If even one is no, close the chart. Wait for the next one. Do this for 1 month, 30 days, every single trade, no exceptions. And watch what happens. Your trade count will drop, your win rate will rise, your confidence will increase. Not because you're taking more trades, because you're taking better trades. And better trades make money. More trades make brokers money. 5-step test, 30 seconds. Every trade. This is how you stop taking bad entries and start taking perfect entries. Stop gambling, start filtering. The market rewards patience. These 5 questions force patience. Use them.